Yes, sir. Sir, very happy afternoon to all. Sir, I hope that for online, audio and video, everything is perfect fine. If yes, those who are attending in online, please put a text. Then I will start the proceedings. Sir, today's agenda is to solve 5 questions from the leverage analysis, which are ICI illustration. Basically, we are going to apply the logic or the concept what we have studied in the leverage analysis. Okay. 5 questions is the target. The question document is available in the description, or you can download it from the ICAI. So when I am solving the answer, you also take the notebook and solve along with me. Yes, sir. Fantastic to the core. Shall I start the proceedings? Super, sir. Sir, very happy afternoon to all. Sir, we are going to solve the ICAI illustrations of the leverage analysis. Before I start solving question number 1, very quickly recall the leverage within short span of time. As we all understood that sales minus variable cost is contribution, minus fixed operating cost is earnings before interest and tax. From that EBIT, we have to pay the interest. You will be getting the earnings before tax. From that, you have to pay tax at the applicable percentage. You will be getting the PAT, which is profit after tax. From the PAT, you have to first pay the preference dividend. You will be getting residual earnings. That residual earnings is full and fully available to the equity shareholders. So divided by number of equity shareholders, you will get the EPS, earnings per share. My dear lovable students, sir, if you see the income statement, actually we are incurring cost. That cost can be classified into 2 categories. Number 1 is variable cost and number 2 is fixed cost. We are not analyzing anything regarding the variable cost. Because if the sales increases, variable cost increases. If the sales decreases, variable cost decreases. No particular analysis is required for the variable cost, or in leverage analysis, we are not analyzing the variable cost. We are analyzing the fixed cost. What this chapter is saying that fixed cost can be classified into 2 categories. Number 1, fixed operating cost and the fixed financial cost. Fixed operating costs such as production overhead, administration overhead, or selling and distribution overhead. These 3 overhead basically pass, PAS pass. I am incurring because of operating the business. Are you all really with me? That is why, sir, such a leverage is called as operating leverage. Such a leverage is called as. So in my cost structure, that is from sales to the EBIT, because of the presence of the fixed operating cost, I am having some business risk. That risk is measured by operating leverage. So operating leverage is equal to contribution divided by EBIT. Whereas my fixed finance cost, my dear lovable students, I may have interest or I may have preference dividend. Because of interest, that is fixed in nature, and also the preference dividend, that is also fixed in nature, my dear. But these are not operating costs. These are fixed finance cost. Because of this, I am having some leverage. That leverage is called as the financial leverage between EBIT and the EPS. This is called as financial leverage. My financial leverage may be only because of the interest, or maybe because of interest plus the preference dividend. If it is only because of interest, my dear lovable students, which is EBIT divided by EBIT minus interest. EBIT minus interest. Are you all really with me? If it is because of interest and the preference dividend, then EBIT divided by EBIT minus interest minus preference dividend divided by 1 minus T. Interest is a pre-tax item and preference dividend is a post-tax item. So I am even converting the preference dividend into a pre-tax item. That is why I am putting 1 minus T. Fantastic to the core. But in any organization, if you are having both fixed operating cost and also fixed financial cost, you will be having double leverage called as combined leverage or combo leverage. Are you all really with me? That combo leverage will be the analysis from the sales to the EPS. Are you all really with me? Sir, that is also maybe because of the interest alone or interest plus the preference dividend. Are you really with me? So that will be calculated as combined leverage is equal to contribution divided by EBT or EBIT minus interest. I have calculated without preference dividend. With this background or backdrop, I am going to solve illustration number 1. This is an ICAI illustration. We are going to apply. Rather than me simply solving the question, I will give lot of analysis for this question. A company produces and sells 10,000 shirts. They are producing 10,000 shirts, selling 10,000 shirts. So we understood that there is no stock, there is no opening stock and there is no closing stock. Selling price per shirt is rupees 500. Every shirt they are selling for 500. Variable cost is 200 rupees per shirt. You tell me, in order to manufacture a shirt, we need cloth, we need button, we need, other items, we have to stitch it. Those expenses are called as variable cost. Without incurring variable cost, you can't make the production. So sales minus variable cost will be the contribution. And the fixed operating cost, look at the word, fixed operating cost, because this manufacturing or this trading will be happening at some factory or at some shop. For that, they have to incur the cost. That is how much lakh? 25 lakh. Calculate the operating leverage is the question. Very simple question. We can easily, move forward. Can I calculate the sales revenue, my dear lovable students? How many units of shirt they are selling? So 10,000 into every shirt they are selling for. So 50 lakhs is the total sales value, my dear lovable students. From the 50 lakh, are they incurring variable cost? Yes, sir. For every shirt, they are incurring 200. So 10,000 into 200 comes to 20 lakh is the variable cost. So from 50 lakh, if you reduce 20 lakh, 30 lakh will be the contribution. 30 lakhs will be the, this amount is contributing for the recovery of the operating fixed cost, right, sir? That is why this is called as contribution. So from this 30 lakh, I am going to incur fixed cost of 25 lakh. So my earnings before interest and tax will be 5 lakhs. Are you all really with me? So I already know that operating leverage is because of the operating fixed cost. Operating. So above the fixed cost is contribution and below the fixed cost is EBIT. So operating leverage is equal to contribution divided by EBIT, which is nothing but 30 lakhs divided by 5 lakhs. 30 lakhs divided by 5 lakhs. 30 lakhs divided by 5 lakhs comes to 6 times is the operating leverage. Actually, this is very huge. Because if 1% change in sales will lead to 6 times or 6% change in EBIT, this is not recommendable. Because tomorrow if 1% sales falls, 6% EBIT will falls. For any concern, for any business, it's not recommended to have more operating leverage. It's better to have less operating leverage. Are you really with me? Because if the operating leverage is more, that concern or company will be having more fixed costs. It is not a pyramid to say that I'm having so much of fixed costs. No. Sir, if the fixed cost is more, automatically the business risk will be more. Business risk will be more. This subject is saying that whenever the risk increases, return also increases. That is why if your operating leverage is 6 times, if the sales increases by 1%, your return will also increases by 6%. Are you all really with me? Fantastic to the core. That's what the first requirement of the question. Calculate the operating leverage. Are you all settled? If the sales are up by 10%, then the compute the impact on EBIT. Positive, they are saying. Sir, this part, first I will be analyzing, then I will give answer. Just listen what I am doing, my dear lovable students. As we all know that sales minus variable cost, contribution minus fixed cost is earnings before interest and tax. We know all the figures. What is the sales? 50 lakhs is the sales. What is the variable cost? 20 lakh is the variable cost. What is the contribution? 30 lakhs is the contribution. What is the fixed cost? 25 lakh is the fixed cost. So the EBIT will be, so we are going to increase the sales by how much percent? 10%. So from 5 lakh, the sales is going to be 55 lakh. Are you all really with me? Because if the sales has been increased by 10%, current sales is equal to 50 lakh. Are you all really with me? Add increase at how much percent? 10 percentage comes to 5 lakhs. So the revised sales will be 55 lakhs. Surely if the sales increases, automatically the variable cost will also increases. Right, sir? Earlier the variable cost ratio, variable was 20 lakh divided by 50 lakh into 100 comes to how much percent? 40 percentage. Are you really with me? So now the new variable cost will be 55 lakhs into 40 percentage comes to 22 lakhs, which is nothing but earlier the variable cost was 20 lakh. What is the increase? 10%. 20 lakh into 10%, 2 lakh. 20 lakh plus 2 lakh, 22 lakhs. Getting it? Sir, 55 lakhs minus 22 lakhs means 33 lakhs is the contribution. That means if the sales has been increased by 10%, even the contribution also increased by 10%. That's why we are not analyzing the contribution, because there is no magnified effect on the contribution. Are you really with me? But this guy, now he will feel as a hero. Sometimes this guy will act as a villain. Are you really with me? Whenever sales goes up, this guy will be treated as a hero. So my dear lovable students, 25 lakh will be 25 lakh. Are you really with me? So from 33 lakh, if you reduce 25 lakh, 8 lakh will be the new EBIT. This will be the impact on EBIT. This will be the impact on. So my dear lovable students, percentage change in EBIT, percentage change in EBIT is equal to, sir, new EBIT minus old EBIT divided by old EBIT into 100. Are you really with me? What is the new EBIT? 8 lakh. What is the old EBIT? 5 lakh. What is the old EBIT? 5 lakh into 100. That means 3 lakh divided by 5 lakh into 100 means 60%. How much percent? Yes, it has to be 60% because we got the operating leverage as 6 times. The interpretation of that is, if 1% change in sales will lead to 6% or 6 times change in earnings before interest and tax. That is the case if 10% increase in sales will lead to 60% change in EBIT. Is the equation perfectly matching? Yes, sir. So what they want in the question, if the sales are up by 10%, then compute the impact on EBIT. EBIT will increase. EBIT will, that means, sir, degree of operating leverage. Sir, now I have calculated the two data with the how much percentage increase? 10% increase. If 2-year data are available, can you calculate the percentage change formula? Sir, operating leverage is equal to, we are having percentage formula. Percentage change in EBIT divided by percentage change in. So I am going to calculate the percentage change in EBIT divided by percentage change in sales. Are you all really with me? Just now we calculated percentage change in EBIT. How much percent? 60%. Are you really with me? So percentage change in EBIT 60%. In the question itself, they said that percentage change in sales is how much percent? 10%. That means operating leverage is equal to 6 times. Are you really with me? That means, my dear lovable students, if the sales are up by 10%, the impact on EBIT will be, EBIT will not be increased by 10%. EBIT will increase by 60%. Are you really with me? That will be the impact on the EBIT. Question number 1. Are you clear? Coming to question number 2 of our ICAI, my dear lovable students. Calculate the operating leverage. Again, we are in the operating leverage. For each of the 4 firms separately, A, B, C and D. Let me ask you a question. For all the concern, will the operating leverage same or different? Different. It depends upon how much fixed cost they are having. Because everyone will not have the same fixed cost. If the fixed cost changes, automatically the operating leverage changes. From the following price and cost data, selling price is 20, variable cost is 6. From this, you can calculate the contribution into number of units. If you put, sir, assume number of units sold is how much? 5,000. You will get the total contribution. Minus, sir, the respective fixed cost has been given in the question. Are you all really with me? You will get the EBIT. Contribution divided by EBIT will give you the operating leverage. So what calculation can you draw with reference to the level of fixed cost and the degree of operating leverage result? This is what the real conceptual understanding. Everyone know contribution divided by EBIT is operating leverage. But for example, for the firm D, they are not having what at all? Fixed cost at all. If there is no fixed cost, don't say, sir, operating leverage will be 0. You will be having operating leverage, which will be exactly 1. Which will be exactly, sir, we can say that they don't have the business risk. They don't have the business risk. If there is no operating leverage, there is no business risk. Because why there is no business risk? They don't have any fixed cost. For example, my dear lovable students, you are having self-occupied property, which is under the income from house property chapter, direct tax. Or you are having let out property. Assume you are staying in a self-occupied property. Sir, your own house, whether the date is, sir, next month 1 or 5 or 10, no tension. Because no one will come and ask you rent. But if you are in a rental property, owner will ask rent on a particular date. Correct? Yes, sir. Then you are having some risk in your life. You can't sleep, aram, say whatever, whenever you want. You can't wake up at morning 10 o'clock and all. Because you have to go to job. Why? Because if you earn only, you can pay the rent. So, in a business, if there is no fixed cost, whether the sales is happening, sales is not happening, I don't have any problem because there is no fixed commitment in my business, right, sir? So, this firm D, this company D does not have a what risk? Business risk. Others company, I have to check, sir. What is the sales unit for every company? 5,000, 5,000, 5,000, 5,000. Are you really with me? Sir, sales revenue. What is the selling price, sir? 20, 32, 50 and 70. Because every company will not sell at the same selling price. Because both or all the 4 are different companies. Getting it? Less variable cost, which is nothing but, man, sir, variable cost is 6, 16, 20 and 50. Are you all really with me? If I minus like that, I will be getting the contribution per unit. Then I have to multiply with the total number of units to get the total contribution. Right, sir? So, I am going to reduce it from 20 rupees. If I reduce 6 rupees, I will get 14 rupees. Into 5,000 units means 70,000 is the contribution. Getting it? From 32 rupees selling price, if 16 rupees goes, means remaining 60 rupees will be with me. Every unit will contribute 60. So, 80,000 rupees is the contribution. Getting it? From 50 rupees, if 20 rupees goes, means 30 rupees, my dear lovable students. So, 30 rupees into 5,000 comes to 1,50,000 rupees is the contribution. From 70 rupees, 50 rupees goes, means balance 20 rupees will be me. Into 5,000 means 1,00,000 rupees will be the contribution. Will all the 4 firms having same fixed cost, different fixed cost? Different fixed cost. What is the fixed cost? 60,000, 40,000, 1,00,000, nil. Are you all really with me? I will be getting earnings before interest and tax. From 70,000, if 60,000 goes, means balance 10,000. From 80,000, 40,000 goes, means from 1,50,000, 1,00,000 goes, means from 1,00,000 0 goes, means 1,00,000. Are you all really with me? Can I calculate the degree of leverage, my dear lovable students? Degree of leverage is equal to, degree of operating leverage is equal to contribution divided by EBIT. Contribution divided by. So for the first company, what is the contribution? 70,000 rupees is the contribution divided by. What is the EBIT? 10,000 is the EBIT. That means how much time? Oh my God, 7 times is the operating leverage. If the sales are increasing, wow. If the sales are decreasing, swaha. That's why leverage is a double-edged sword. Are you all really with me? So I'm coming to the second company, my dear lovable students. Sir, what is the formula for operating leverage? Contribution divided by, what is the contribution? 80,000 divided by 40,000. 80,000 divided by 40,000 means as compared to the first company, this company is less risky because their business risk are less as compared to the first company. Are you all really with me? Coming to the third company, operating leverage is equal to contribution divided by EBIT. That means 1,50,000 divided by 50,000 comes to 3 times. I will rank the first company as number 1 for the business risk. I will rank the third company as second company for the business risk. And I will rank the second company as the third company for the business risk. Are you all really with me? Sir, there one person is really enjoying, sir. Company number 4. Contribution divided by EBIT. What by what? 1 lakh divided by comes to 1 time. 1 time. Sir, if it is exactly equal to 1, we are having a lot of interpretation. We can say that there is no fixed cost. Since there is no fixed cost, there is no business risk. Are you all really with me? Everyone will do this question. There is no doubt about it. But whether you are understanding this conclusion or not is what the understanding of the subject logically. Operating leverage exists only when there are fixed cost. If there is no fixed cost, there is no operating leverage. Clarity? In case of firm D, which is the fourth firm, there is no magnified effect on EBIT due to change in sales. Since there is no fixed cost, if the sales increases by 1%, EBIT will also increase by 1%. If the sales decreases by 1%, EBIT will also decrease by 1%. There is no magnified effect. Clarity? A 20% increase in sale have result in 20% increase in EBIT for the last company. Because there is no fixed cost, my dear lovable students. Up to this, are you able to appreciate? But in case of other firms, because the last guy is an exception, they don't have any fixed cost at all. Operating leverage exists. Why? Because all the other firms are having fixed cost. It is a maximum in firm number A, the first firm, followed by firm number C, that is the second, and minimum in firm number B. We have also ranked the company, right, sir? So the interception of degree of leverage is 7 is that. Sir, what is that 7 times represent? 1% change in sale result in 7% change in EBIT level in the direction of change of sales level of firm A. Look at the English. In the direction of the change of sale. That means if the sales increases by 1%, EBIT increases by 7%. Whereas if the sales decreases by 1%, EBIT decreases by 7%. That means in the same direction it will move. Comfortable? I hope that since we had a fantastic conceptual discussion, every bit and word of line you are able to appreciate and understand. Can I proceed to illustration number 3? Are you comfortable with illustration number 1 and 2? Coming to illustration number 3, first we will be solving and we will be filling. A firm's details are as follows. Actually, from here onwards, you itself can deal it. Sales, total 24 lakhs is the sales value. Good for the organization. Variable cost is 50%. 12 lakhs is the variable cost. So automatically contribution is also 12 lakhs. Fixed cost is 10 lakh. This is fixed operating cost. If there is fixed cost, there will be leverage. Such a leverage is called as operating leverage. It has borrowed rupees 10 lakh at the rate of 10% per annum. So in the capital structure, they are having debt. So 10 lakhs into how much? 10% comes to 1 lakh is the interest. And its equity share capital is rupees 10 lakh. Equity share capital is rupees of how much each? That means 10 lakh divided by 100 comes to 10 is the number of equity shares. We need number of equity shares to find out the EPS. Correct? Consider tax at the rate of 50%. We need the tax rate of the company. So they want operating leverage. We can easily find out. They want financial leverage. We can easily find out. When we calculate both operating and financial leverage, we can find out the combined leverage. They want the return on investment. Actually, this is a ratio analysis chapter. What chapter? But still, I will do the sum for you. If the sales are increased by how much lakh? 6 lakh. What will be the new EBIT is a question. Instead of saying sales increased by particular percentage, they have given by way of amount. Okay, fine. We can find out the percentage change in sales. Once you got the percentage change in sale, and if you are having the, sir, they want the new EBIT, so you have to play with the what leverage? Operating leverage. Easy question, straightforward question. Can we? Yes, sir. Sir, what is the sales given in the question? 24 lakhs is the sales. What is the variable cost? 50%. So 24 lakh into 50% comes to, so from 24 lakh, if 12 lakh goes means contribution is 12 lakhs. Comfortable. Fixed cost is given in the question as how much lakh? 10 lakh is the fixed cost. So what will be the EBIT, which will be 12 lakhs minus 10 lakhs comes to 2 lakhs will be the earnings before interest and tax. First pay the interest. What is the debt component? 10 lakhs into 10% comes to, so from 2 lakh, if I pay 1 lakh, I will be having balance 1 lakh with me. That is what earnings before tax. Comfortable. Let's tax at the rate of 50%, which is 1 lakh into 50% come to 50,000. So from 1 lakh, if 50,000 goes, the balance PAT will be 50,000. How much is the total equity share capital? So 10 lakhs divided by, what is the face value? 100. So how much number of equity share? 10,000. So 50,000 divided by 10,000 means 5 per share is the earnings per share. Comfortable? Is it very easy? That's it. Income statement has been filled. What is the first requirement of the question? What leverage? Sir, operating leverage is because of whom? Fixed cost. So what is the formula for operating leverage? Contribution divided by, okay, 12 lakhs and 2 lakhs, right, sir? So 12 lakhs divided by 2 lakhs means how much time? 6 times. Let me ask you a question. What is the interpretation of this 6? If 1% change in sales will lead to 6% change in EBIT. Shall we proceeding? Yes, sir. Next one, sir, financial leverage. Financial leverage in this question, is there any preference dividend? No, sir, there is no preference dividend. So in this question, financial leverage is because only of the interest. So EBIT divided by EBT or EBIT minus interest. Since all information has been given in the question, I will be taking divided by EBT. If interest information is missing, EBIT divided by EBIT minus interest. Getting it? So what is 2 lakh divided by how much lakh? 1 lakh. So 2 lakhs divided by 1 lakhs comes to 2 times. What is the interpretation of this 2 times? If EBIT has been changed by 1%, EPS will changes by 2%. Comfortable? Coming to the combined leverage, in my hand I am having operating leverage and also financial leverage. So operating leverage of 6 times into 2 times comes to 12 times is the combined leverage. Oh my God. That means if there is 1% change in sales will lead to 12% change in EPS. Very brilliant, right, sir? Sir, return on investment. Return on. Look at the formula. I have not explained the formula. Just first understand. Return on investment is equal to return by investment. Return on investment is equal to return divided by, for example, you are putting, for example, simple example, blank example, then I will explain in ratio analysis very depth. For example, you are getting 10,000 rupees interest from a bank. You are putting 1 lakh rupees as FD. Are you really with me? You can say that 10% is your return. Is there any problem? No, sir. This is your return. This is for investment. So, return on investment is equal to return divided by investment. Comfortable? Now, in this question, my dear lovable students, sir, the return means residual earnings. Because after payment of interest, after payment of tax, after payment of preference dividend, everything, what is the balance available with the equity shareholders? Are you really with me? So, this return on investment, we have taken from the angle of the equity shareholders. Equity, how much is the residual earnings for the equity shareholders? 50,000. So they can enjoy a profit after tax of 50,000. Are you really with me? So this is the return. In order to enjoy this 50,000, they have to invest in the company. They have invested. What is the equity share capital? 10 lakhs is the equity share capital. Are you really with me? So 50,000 divided by 10 lakhs into 100 means 5% is the return on investment. Always return will be represented by way of percentage. We will say that 10% return pa, 20% return pa, 30% return pa. Are you really with me? So always we will express the return in percentage. This return on investment is from the angle of the equity shareholders. If you want, you can calculate the return on investment from the company as a whole also, which is nothing but EBIT divided by capital employed. EBIT divided by EBIT. From EBIT, sir, some return will go to the debt holders. From EBIT, some return will be enjoyed by the preference shareholders. From EBIT, some return will be enjoyed by the equity shareholders. Are you really with me? What is the EBIT of this company, my dear lovable students? 2 lakhs. 2 lakhs. 2 lakh divided by, sir, will I take only equity or only debt or debt plus equity? Debt plus equity. Because this 2 lakh is going to be enjoyed by 2 people. Are you really with me? What is the total capital employed? Debt is how much? 10 lakhs. Plus equity how much? 10 lakhs. That means how much lakh? 20 lakhs. So 2 lakhs divided by 20 lakhs into 100 means 10%. This return on investment is from the company as a whole. But in ICI answer, they have written only from the angle of the equity shareholders. But question did not ask the return of investment from whose angle. Are you really with me? Since the ICI has solved from the angle of the equity shareholders, even in answer, I am also following the same way. Are you really with me? If the same thing has been asked in exam, I would have write both the answer. It is from the angle of the company and also from the angle of the, because I have 2 formulas. Even more formulas are there to find out for return on investment. That I will teach you when we do the chapter ratio analysis. Shall I proceed? Sir, if the sales are increasing by how much lakh? 6 lakh. What will be the new EBIT is what the discussion. Are you really with me? So, my dear lovable students, I can calculate the new EBIT. There are different ways of solving that part is there. Right, sir? They want only what is the new EBIT. Let me show you the different ways. Sir, sales minus variable cost contribution minus fixed cost earnings before interest and tax. What is the sales given in the question? 24 lakhs. Variable cost 12 lakhs. Super, sir. Contribution 12 lakhs. Are you really with me? What is the fixed cost? 10 lakhs is the fixed cost. What is the EBIT? 2 lakhs is the earnings before interest and tax. Comfortable? My dear lovable students, if the sales increased by 6 lakh plus 6 lakh, it will be 30 lakh. Are you all really with me? I can follow normal tabular approach. I understood that my variable cost ratio is how much percent? So 30 lakh into 50% will be, the balance 15 lakh will be the contribution. Are you really with me? Then fixed cost will be 10 lakh. Anyway, it will not change. Then my new EBIT will be 5 lakh. This is method number 1 of solving the question. Are you all really with me? Or there is no need to go this much and all. Sir, I know that what is the operating leverage? Operating leverage is equal to contribution divided by, already I worked out, which is nothing but 12 lakhs divided by 2 lakhs comes to how much time? 6 times. What I understood, if 1% change in sales will lead to 6% change in EBIT. Comfortable? Now I am going to calculate the percentage change in sales. Are you all really with me? Which is nothing but new sale minus old sale divided by old sale into 100. Comfortable, sir? What is the new sale? 30 lakhs minus old sale 24 lakh. Difference they themselves actually given. Divided by old sale 24 lakhs into 100. Comfortable? That means 6 lakhs divided by 24 lakhs into 100 comes to 25% is the percentage change in sales. I know the formula. This is a relationship between sales and what? EBIT. If 1% change in sales will lead to 6% change in EBIT. Right, sir? Here actually 25% sales has been increased. Then 25 into 6 comes to 150%. Who should increase? It is only an increase. Are you all really with me? That means, my dear lovable students, new what IT is equal to? Old EBIT plus increase. Are you all really with me? What is the existing EBIT? 2 lakh is the existing EBIT. Getting it? So 2 lakh plus you will be having an increase of how much percent? That means 2 lakh into 150 percentage. Are you really with me? So 2 lakh, sir, plus 2 lakh into 150 means 3 lakh plus 2 lakhs comes to 5 lakh will be the new earnings before interest and tax. I got 5 lakh rupees as answer. Are you really with me? Or I can solve the same as I understood that method number 3. Hello, sir. I understood that sales and EBIT, earnings before interest and tax. If 1% change in sales will lead to 6% change in EBIT. Comfortable? My dear lovable students, sir, how much percent sales has been increased? 25%. Alright, sir. Then it will lead to 150% increase in EBIT. What, man? So the what EBIT is equal to 100% of the existing EBIT plus 150% of the increase in EBIT, which will be 250% of the current EBIT. Right, sir? What is the current EBIT given in the question? 2 lakhs. That means 2 lakh into 250% comes to 5 lakh. That way also you can calculate the 5 lakhs. Are you all really with me? So this is what the answer, man. The new EBIT. New EBIT. So that's it. The new EBIT will be, I am attaching the working note. I have already calculated. Sir, it is how much lakhs, man? 5 lakhs. Can I proceed? That's it with regard to illustration number 3. Are you comfortable? Are you able to place our discussion? Now I am moving into illustration number 4. We are having illustration number 4 and illustration number 5. Following information is relating to UE Company Limited for the current financial year, whatever it may be. If Abhishek Sharma also, you don't have any problem. Come on. Equity share capital, how much lakh? 50 lakhs. 50 lakhs. So 50 lakhs divided by 10 means 5 lakhs is the number of equity shares. This I need to find out the EPS. 12% bond of 1000 each. Total how much lakh? 37 lakh. So 37 lakh into 12% comes to 4,44,000 is the interest. Sales 84 lakh given in the question. Fixed cost excluding interest. Why, sir? There are 2 types of fixed costs are there. Fixed operating cost and fixed financial cost. Because financial cost data they have separately given. So the fixed operating cost are 6,96,000. Financial leverage they have given 1.49 times. Answer given in the question. Profit volume ratio they have given. So we can easily find out the variable cost ratio. Sales minus variable cost ratio. Sir, we will get the profit volume ratio. Income tax applicable are 40%. You are required to calculate the operating leverage. You are required to calculate the combined leverage and also the EPS. Show calculation up to how many decimal? 2 decimal point. Pakka? This question will teach us, sir, certain important things. I will tell you how to proceed or how to move forward, my dear lovable students. First, what and all given in the question I am going to write. Is the sales given? By seeing the question, please help me. What is the sale? 84 lakh is the sales. Is the variable cost ratio given or, sir, PV ratio given? I don't want variable cost ratio at all because this analysis itself is not VCR analysis. Yes, sir. So contribution will be 84 lakhs into what is the PV ratio? 27.55%. So 84 lakhs into 27.55% comes to 23 lakh 14,200 is the contribution. Is that? From that I have to reduce the fixed operating cost. Is it given in the question? Yes, sir. How much? 6,96,000. 6,96,000. So 23,14,200 minus 6,96,000 means what is the earnings before interest and tax? 16,18,200 is the earnings before interest and tax. So 16 lakh 18,200 is the EBIT. Are you getting it? My dear lovable students, now I am deviating a little from the question. Just listen to me. Have they given operating leverage in the question? No, sir. Operating leverage has not been given in the question. Operating leverage is equal to contribution divided by EBIT. What is the contribution? We have find out. 23 lakh 14,200. Is EBIT available in the question? 16 lakh 18,200. Are you really with me? That means 23 lakh 14,200 divided by 16 lakh 18,200 means 1.43 times is the operating leverage. Accepting? Okay. I am doing the question. Please don't write because I am going to write a wrong thing. Are you really with me? My dear lovable students, is interest on debenture given in the question? Yes, sir. What is the value of interest on debenture? 4,44,000. So from the EBIT, I am reducing 4,44,000. Right, sir? So 16 lakh 18,200 minus 4,44,400 comes to 11 lakh 73,070. 16 lakh 18,200 minus 4 lakh 44,000 comes to 11 lakh 74,200. Right, sir? My dear lovable students, is financial leverage given in the question? If that is the case, it should be EBIT divided by EBT. Are you really with me? What is the EBIT? 16 lakh 18,200 divided by what is EBT? 11 lakh 74,200 comes to 1.37 or 1.38 times. What is given in the question? 1.49. It's not matching. It's not matching. Are you really with me? That means if the answer has been given in the question, don't go through this method or don't follow this. What you are supposed to do? Have they given financial leverage? Yes, sir. Financial leverage is equal to EBIT divided by EBIT minus interest. Are you all really with me? Is equal to 1.49 times, which is given in the. That means 1.49 is equal to. Is EBIT available? Yes, sir. 16 lakh 18,200 divided by again 16 lakh 18,200 minus interest. Minus interest. Are you all really with me? Now I am cross multiplying. Take the calculator. 16 lakh 18,200 into 1.49 comes to 24 lakh 11,118. Right, sir? Is equal to minus 1.49 interest. Right, sir? Minus, sir, 1.49 interest is equal to 16 lakh 18,200. Are you all really with me? That means 1.49 interest is equal to 16 lakh 24 lakh 11,118 minus 16 lakh 18,200. Are you all really with me? So 1.49 interest is equal to 7 lakh 92,918. So interest is equal to 7 lakh 92,918 divided by 1.49 comes to 5 lakh 32,160. 160. Are you all really with me? But my dear lovable students, on the given data, they gave debt, bond, debenture of how much? Amount 37 lakhs at the rate of 12%. Are you all really with me? This comes to only 4 lakh 44,000. Are you all really with me? My dear lovable students, 5 lakh 32,160 is the total interest we are getting as per the financial leverage. Out of that, 4 lakh 44,000 is the interest on bond. Is it bond? Yes, sir. Then I am having what interest? Other interest, which is 5 lakh 32,160 minus 4 lakh 44,000 comes to 88,000. 160 is the other interest. You may have a doubt from where this interest is coming. Correct? My dear lovable students, I will tell you a logic. Sir, this is from 1st of April. Are you all really with me? This is what? 31st of March. Are you all really with me? Sometimes during the year, in between an year, after 30th, 31st of December or Jan or Feb, sometimes we would have redeemed the debt. So the debt may be there for some period in a financial year. For that period, I would have paid interest of 88,160. They have given the details only what is pending, sir, for the current financial year on 31st of March something. So they would have borrowed either in between and they would have repaid in between. Or that borrowal may be there in the opening and they would have repaid in between. That I will know only if I see the cash flow statement or some other part of the financial statement. Are you all really with me? Sir, then how you know that this much debt was there? That is an indication of the financial leverage. That is the indication of the. Now I will fill my answer as you tell me interest on debenture. What is the total? 37 lakh. 37 lakhs into 12% comes to 4,44,000. Are you getting it? Other fixed interest, I don't know whether it is for debenture or loan or debt. I don't know. I will be just writing the balancing figure. What is the difference, man? 88,160. Are you all really with me? So now you tell me from 16,18,200, if you reduce 4,44,000 and 88,160, you will get 10,86,040. Now take your calculator and you put it EBIT divided by EBT, that is 16,18,200 divided by 10,86,040. You will be getting 1.49 exactly. That means it is matching with the details available in the question. Can I proceed? Now I have to pay tax at the rate of 40%. So 10,86,040 into 40% comes to 4,34,416. What is the PAT? 10,86,040 minus 4,34,416 comes to 6,51,624. Are you getting it? What they want from the question? Operating leverage, which we can easily find out. Already actually we find out, which is contribution divided by EBIT. What is the contribution? 23,14,200 divided by EBIT 16,18,200. Getting it? That means 1.43 times is the operating leverage. Can we once again, sir, already we have checked the financial leverage, leave it. Can we do the combined leverage? Sir, which is nothing but operating leverage into financial leverage, which is nothing but 1.43 times into 1.49 times comes to 2.13 times. Comfortable, sir? Or you can straight away, if you want contribution divided by EBT also you can apply, right, sir? What is contribution? 23 lakh 14,200 divided by EBT 10,86,040. What is the combined leverage you are getting? 2.13. That is also allowed. Are you all ready with me? Before I move to the next question, always I should have a cross check that whether my answer and the question facts are matching or not. Financial leverage, which is nothing but EBIT divided by EBT. We already done actually. What is the EBIT? 16 lakh 18,200 divided by EBT 10,86,040 comes to 1.49 times. It is exactly matching with the question, right, sir? So accordingly, the other interest will be, sir, 88,160. We also got 88,160. Sometimes that debt would have been repaid. That is why that debt details has been not been given in the question. I'm moving into the last question from the ICI Illustrations, illustration number 5. Following are the selected financial information of A Limited and B Limited for the current financial year. Two companies' data has been given. Can we? Variable cost ratio is 60% and 50%. Fine. With this, can we find out the PVR, profit volume ratio? If 60% is the VCR, 40% will be the PVR. If 50% is the VCR, 50% will be the PVR. Interest they themselves given 20,000 and 1 lakh. Operating leverage they give 5 and 2. Financial leverage they give 3 and 2. Tax rate they give 30% and 30%. You are required to find out the EB80. No problem. Whenever operating leverage is there, we can find out the EB80. Because operating leverage and EB80 are connected. Correct? They want sales. Fine, no problem. Sir, once I get the EB80 and I can back work and go up to the sales. They want fixed cost. No problem. Sir, whenever I am having operating leverage, I can find out the fixed cost. Identify the company which is better placed with a reason based on the leverage. So we have to evaluate the business risk. Those who are having less operating leverage will be good. Right, sir? So I'm going to find out the, sir, EB80. You tell me degree of financial leverage given in the question. Yes, sir. How much time? For the company A. I'm going to talk about company A. Be with me. For company A, financial leverage is how much time? So 3 is equal to, do you know EB80? Don't know EB80. So EB80, sir, divided by EB80 minus interest of company A, 20,000. Can we cross multiply? Yes, sir. That means 3 EB80 minus 60,000 is equal to EB80. Are you really with me? That means 2 EB80 is equal to 60,000. Are you really with me? So EB80 is equal to 60,000 divided by 2. 30,000 is the earnings before interest and tax of the first company. Getting it? Super fantastic to the core. Sir, now we have to calculate the sales. Sir, what is the first requirement? You are required to find out the EB80. Right, sir? EB80 of first company or second company, both the company. Both the company. So whenever you are having question like that, you follow the marginal cost approach, which is nothing but put the column like this, better. Which is sales minus variable cost, contribution minus fixed cost, earnings before interest and tax. From that, reduce the interest, you will be getting the EBT, earnings before tax. Less tax at the rate of, is both the company having 30 or different? Both the company same. So tax rate at the rate of 30%. You will get the PAT, profit after tax. That's it. Or they want EPS. No, sir. Sir, first company sales. This is first company A and B. First company sales given, not given. Not given. Variable cost given, not given. Not given. Contribution given, not given. Not given. Fixed cost given, not given. Not given, sir. EB80 given, not given. We found out. Just now we find out. How much EB80? 30,000 is the EB80. Comfortable, sir? Is the interest given, not given? Given. How much? 20,000. So from 30, if 20 goes, is the earnings before tax. From that, pay tax at the rate of 30%, 3,000. 7,000 will be the PAT. Comfortable? Yes, sir. Now I am having EB80. With that EB80, I can operate the operating leverage. Right, sir? So operating leverage is equal to contribution divided by EB80. What is the operating leverage of first company? 5 is equal to contribution divided by 30,000. Can I cross multiply? So contribution is equal to 5 into 30,000 comes to 1,50,000. Can I write here 1,50,000? Automatically I'll be getting the fixed cost of 1,20,000. Are you getting it? Sir, they have given what ratio? Variable cost ratio. Of how much? If this is 60, this will be 40. Right, sir? If this 1,50,000 is 40%, can I reverse it? So 1,50,000 divided by 40% means 3,75,000 will be the sales into 60% will be 2,25,000 will be the variable cost. Comfortable? Now what and all figures they want we can calculate. Pakka? Same way for the company B. Even for company B also, by using financial leverage, can I calculate the EB80? So financial leverage is equal to EB80 divided by EB80 minus interest. How much is the financial leverage? 2 is equal to, I don't know EB80. So EB80 divided by EB80 minus how much? 1 lakh. Super, sir. Can I cross multiply? If you are having any difficulty or if you are not able to appreciate, put 2 by 1. That's it. Numerator, denominator, make it. So 2 EB80 minus 2 lakh is equal to EBIT. Are you really with me? That means basically 2 EBIT minus EBIT is equal to 2 lakh. Are you really with me? Basically EBIT is equal to how much lakh? 2 lakhs. Comfortable? So I can fill here, man. EBIT as how much lakh? 2 lakh. Interest already given in the question. 1 lakh. From 2 lakh, if 1 lakh goes, 1 lakh is the earnings before tax. From that 30,000 tax, you will be getting 70,000 as PAT. Comfortable? Now I am having operating leverage, right, sir? Use the what leverage? Operating leverage to calculate the contribution. Operating leverage is equal to contribution divided by EBIT. What is the contribution? 2 lakh. What is operating leverage? 2. 2 is equal to contribution divided by 2 lakhs. Are you really with me? So contribution is equal to 2 lakh into 2 comes to 4 lakhs is the, that's it, man. I can write here 4 lakhs. So automatically the gap will be, sir, why sir fixed cost is not same? Both are different company, man. Then how it will be same? Correct? Yes, sir. Sir, what is the contribution ratio? If this is 50%, this will be 100%, right, sir? So 8 lakh will be the sales of the first company, right, sir? 4 lakh will be the variable cost. Pakka? Now I am going to the answer format as per ICI. Whatever they want, I can fill it. EBIT. So for company A, the EBIT will be 30,000. Now I am dealing with company A first. Okay, sir. Sales. Sir, now you are having EBIT contribution with you. By using the contribution we have calculated, no. 1,50,000 divided by 40%. We got 3 lakh. So 1,50,000 divided by 40% comes to 3,75,000 is the sales of the first company, right, sir? Now contribution. Hello, sir. Contribution we calculated by using the operating leverage. Correct? So we already find out, man. I'm just attaching the working note. So working note you have to refer there. What is the answer of contribution? 1,50,000 is the contribution for the first company. Comfortable? Now fixed cost, which is just a balancing figure, right, sir? Contribution minus EBIT. I can attach the working note as 1,20,000. First company ka loss. Are you really with me? Coming to the second company, man, EBIT, by using the what leverage? Financial leverage. I can work out the EBIT. Already worked out the EBIT of the second company is how much lakh? 2 lakhs. Are you all really with me? I can work out the sales of the second company, which is nothing but contribution is how much lakh? 4 lakh. 4 lakhs divided by, so 4 lakhs divided by 50% comes to 8 lakh is the sales of the second company. Comfortable? Coming to contribution, we can work out the contribution by using the operating leverage. Pakka? My dear lovable students, the contribution of second company is 4 lakhs. Are you getting it? And the fixed cost, which is nothing but a balancing figure. We already worked out the fixed cost. Fixed cost of the second company is 2 lakh. That's it with regard to that question. Are you all really with me? Now, after filling everything, they have written the statement. Don't do this. Do that first. Pakka? Now, what and all given, sir? Now, what is given in the question? Variable cost. Interest, how much? 20,000 and 1 lakh. Then, tax rate at the rate of 30%. Nothing has been given in the question. By using this, we worked out the EBIT, right? How much? 30,000 and 2 lakhs. This we have gone up by using the financial leverage. Are you really with me? From 30,000, 20,000 goes means 10,000. And from 2 lakh, 1 lakhs goes means 1 lakh. So this into 30% come to 3,000. Balance will be 7,000. Comfortable? And 1 lakh into 30% will be 30,000. Balance will be 70,000. Comfortable? Now fixed cost. Sir, I don't know. But from the EBIT, I can move up to the contribution by using the operating leverage. I got as 1,50,000 and 4 lakhs. Are you really with me? Automatically 1,20,000 will be the fixed cost and 2 lakh will be the fixed cost. Comfortable? Now with me, I am having contribution. I can move into the sales by using the profit volume ratio. Comfortable? Which is 3,75,000 8 lakhs. So automatically variable cost will be 4 lakhs and 2,25,000. Getting it? Sir, comments based on the leverage. Comments based on the company B is better than company A of the following reason. Who's better? Company B. Why? This you should understand. Because capacity of the company B to meet the interest liability is better than that of company A. EBIT to interest ratio. What to what ratio? Look at here. This ratio we have not studied because we are going to study only in the ratio analysis. Look at here. What is the EBIT of the first company? 30,000. They are paying interest of 20,000. Correct, sir? So, 30,000 divided by 20,000 means how much? 1.5. That means if my interest is 1 rupee, my company is earning 1.5 rupees. Correct, sir? But here, sir, 2 lakhs divided by 1 lakh, the second company. 2 by 1 comes to 2. Hello, sir. So they are owning, the first company is earning only 1.5 rupees. But my second company is earning 2 rupees. Who is better? Second company. Because I have to pay 1 rupee as interest, but I am earning 2 rupees. But the first company, I have to pay 1 rupee as interest. I am earning only 1.5 rupees. So who is better? Second company is better because this is called as interest coverage ratio, which we will be discussing in the ratio analysis. So 1.5 times and 2 times. This is one reason. The another reason, company B has the least what risk? Financial risk. As the total risk. That is combo risk. What is combo risk? Combined leverage, which comprises of operating and financial leverage. Is the combined leverage given? Not given. Not given. But we can find out. For first company, operating leverage into financial leverage. 15. Whereas for B, 4 times. Oh my God. First company is having 15 combined leverage. That means if 1% sales falls, 15% EPS falls. Correct. Whereas second company is not that much risky. Because if the 1% sales falls only, so business and financial of company B is lower because here it is 15 and 4. So for the purpose of comparing two companies, my dear lovable students, what we will be doing, we will be taking the combined leverage as the base for the comparison. We will be taking the combined leverage as the base for the a company who are having more combined leverage will be having more risk. A company who are having less combined leverage will be having less risk. These are the 5 illustrations of the ICAI. Are you comfortable? Sir, are you able to appreciate or place the concept what we have discussed to apply in the question, sir? If that is the case, my dear lovable students, solve all the 5 questions by yourself. Don't follow any sort of format. In the answer, I would have, sir, done some format. Right. This is for my easy writing. That's it. Whatever format suits you, whatever, sir, way suits you, do by yourself. And those who are in online, after you complete the 5 questions, comment as completed. Sir, are you all really with me? So in the coming tomorrow's class, I will be doing the book back. You don't try that. Just you redo this 5 question as assignment. We are having, I think, nearly 12 questions are there in this chapter for the purpose of solving. And all the 12 questions are past examination questions. Like this only question will be coming from the chapter leverage analysis. Are you all really with me? So we'll be solving tomorrow, sir, some question, I don't know exactly number, maybe 3 or 4 or 5 based upon the question. Because first question we can easily solve it. Second question we can easily solve it. Third question again we can easily solve it. Fourth question we can quickly knock it off. Fifth question also we can knock it off. Sixth question also we can knock it off. Like that. Sometimes by 4-5 question you need to practice those questions. And it's better to do on a different day. Pakka, sir? So, Saturday and Sunday will be completing this book back whatever possible. Sir, if you are not able to complete fully, I will not wait on Monday. I will start with the ratio analysis on Monday. And whatever balance is there will be, sir, keep on doing from the Monday, Tuesday, Wednesday, Thursday, Friday, like that. Are you all really with me? We'll meet at the appropriate time. Thank you. Bye-bye from me.